If you are anything like me, you probably realize that close to 100% of your stocks are in the United States. Now, there's nothing wrong with that. The US market is home to many of the world's best companies. It dominates global innovation and has rewarded investors handsomely over the long term. But the problem is this: when you put almost all your eggs, or in this case, all your bolas, into one country, you are essentially betting that the United States will continue to outperform the rest of the world for years to come. Depending on how things turn out, it can either turn out to be a very good bet or a not so good one. That's why many analysts advocate for international diversification. By spreading your investments across different countries, you are no longer relying on just one economy to do well. Instead, you reduce the risk that a single market or currency or policy shift can determine your entire financial outcome. In fact, we are already starting to see this play out. In 2025, international markets have already outperformed the US market by a wide margin. And going forward, many analysts are expecting the US to underperform international markets over the next decade. So, in this video, we will be looking at whether you should start investing internationally. If so, how much should you allocate to international markets? And finally, what can you invest in to achieve international diversification? Alright, let's jump right in. The strongest case for investing in international stocks is not so that they can potentially deliver higher returns in the future, but rather it is so that they can reduce the risk of relying on a single market and, more importantly, on a single group of companies. Today, the US stock market is extremely concentrated in a narrow set of companies and sectors. By the end of 2025, the 10 largest companies account for nearly 41% of the entire US stock market by market value, with most of them being either technology or AI-related firms. Sure, when things are going well, this kind of concentration feels incredible, as a handful of stocks can carry your entire portfolio to the moon. But the issue comes when those stocks start to underperform. History shows that markets often perform strongly during periods where concentration is rising, which is exactly what we have seen in recent years. But it is the part that comes after that we need to be wary of. When concentration starts to decline, the returns will tend to fall accordingly. Even the International Monetary Fund has sounded the alarm on this, warning that if mega-cap stocks ever fail to deliver the earnings growth needed to justify current valuations, investor sentiment could deteriorate quickly, dragging down the broader markets down with them. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Recency bias is a strong thing. After more than a decade of strong US market performance, many investors now argue that it makes sense to invest only in the United States. But what often gets forgotten is that leadership between the US and international markets has always been cyclical. From 2000 to 2009, a period which is often called the lost decade, the S&P 500 delivered negative real returns, while international stocks posted positive gains. Back then, if we had argued that the United States would dominate global markets for the next 15 years, most people would have laughed you out of the room. The same pattern appeared earlier as well. During much of the 1980s, international markets once again outperformed the US, driven by stronger growth in Japan and Europe, a weaker US dollar, and lower relative valuations abroad. Market leadership has always moved in waves, rather than in straight lines. And history shows that what has worked best in the past is rarely what will work best in the future. This is why many analysts today expect the cycle to flip around. Right now, equity valuation gaps between the US and the rest of the world remain wide. Because of this, they believe that international markets may offer higher returns relative to the US over the next decade. And this isn't just about geographic diversification alone. International diversification also gives you sector diversification. The US market today is heavily concentrated in technology and communication stocks. In contrast, international markets have much higher exposure to sectors such as financials, industrials, energy, healthcare, and consumer staples. While some investors may argue that technology is the future, therefore this concentration is justified, history often suggests otherwise. In the 1800s, financial companies led the market during the expansion of banking and capital markets. That shifted to railroads in the early 1900s, as transportation infrastructure became the backbone of commerce and national development. Then in the late 1980s, US leadership once again shifted toward industrials, energy, and financials. It was only after 2009 that US technology began its long period of outperformance, driven by the rise of smartphones, cloud computing, platform economics, and near-zero interest rates that favored growth stocks. Looking forward, the sector's leadership could shift again. For all we know, it could move towards healthcare as populations age and medical technology advances. Or it could move towards energy as the world invests heavily in electrification, grid infrastructure, and resource security. Or it could be entirely something else that no one expects. By diversifying internationally, I'm admitting that I'm not smart enough to predict which sector or which country will win next. And the good news is that I don't have to. International diversification is not about making a bold prediction. It is about building a portfolio that can still work regardless of which period we are in. But then, don't investing in international stocks carry higher risk? In some ways, yes, they do. In Ben Felix's video, Investing in Emerging Markets, he explains that some foreign markets, especially emerging markets, face risks that aren't common in the US. One of these is what he calls disaster risk, which he refers to as rare but extreme events where an entire market becomes uninvestable. For example, after World War II, the Japanese stock market lost about 97% of its value between 1945 and 1949. Then in China, the stock market was effectively shut down for decades following the Communist Revolution. And more recently, Russia was removed from major emerging market indexes after sanctions and capital controls made foreign ownership impossible. Then there's also the issue of stagnation. Japan's Nikkei index famously peaked in 1989 and took more than 30 years to regain that level in nominal terms. This shows that even developed markets can experience extremely long periods of weak or uneven returns. However, while much of that is true, avoiding international stocks entirely creates a different kind of risk. As mentioned earlier, when you invest only in one country, you are making a concentrated bet on a single economy, a single currency, and a single market cycle. If that market goes through a long period of underperformance, as the US did from 2000 to 2009, your entire portfolio would be greatly affected. At the same time, you are also taking on valuation risk and concentration risk, where a small group of companies end up driving most of your returns. So then, how much should you allocate to the international markets? While there is no single perfect number, since the right allocation will depend on your investment objective, risk tolerance, and time horizon, what's useful is how closely major institutions converge on a similar range. For example, Morningstar's portfolio allocation suggests that an allocation of 15% to 40% in international equities is sufficient to capture most of the diversification benefits without increasing long-term risk. Schwab arrives at a similar conclusion as well. It states that international stocks should make up at least 5% and as much as 40% of equity portion of a portfolio. JP Morgan also highlights that 25% to 30% in international equities can help to mitigate concentration risk in the S&P 500 while providing a source of potential outperformance over full market cycles. Meanwhile, the FTSE All-World Index currently allocates roughly 60% to the US and 40% to international markets. Within that international portion, about 5.7% is in Japan, 3.4% is in the UK, 3.4% in China, and even Singapore has a 0.34% allocation. What's interesting is that diversifying internationally has historically not required an investor to give up much of its long-term returns. From 1950 to 2015, the S&P 500 delivered an annualized return of about 11.2%, while a 70% US, 30% international portfolio returned around 10.9%. In other words, the difference in performance was very small. In exchange, the globally diversified portfolio experienced lower volatility. That means that the returns were smoother over time with smaller drawdowns and less extreme swings. But more importantly, it had a higher Sharpe ratio, meaning those returns were earned with less risk. Or to put it another way, by diversifying internationally, while you may give up a small amount of performance, in return, you gain greater stability, less dependence on a single market, and better risk-adjusted outcomes over the long run. So then, how do you diversify your portfolio internationally? For most people, the simplest approach is to buy a single fund that holds both the US and non-US stocks in global market capitalization weights. The cheapest option that I could find is the Invesco FTSE All World UCITS ETF, ticker symbol FWRA. It is domiciled in Ireland, which means lower dividend withholding tax, and it also comes with a very low expense ratio of 0.15%, which is even lower than VWRA's 0.19%. With this ETF, you get instant exposure to thousands of companies around the world, with roughly 60% in the US and 40% outside the US. The benefit of this approach is that you will never have to decide when to increase or reduce your international allocation. The index will automatically rebalance itself based on current market values, which helps to remove the temptation of trying to time regions or chase performance. However, if you already own a US fund such as the S&P 500, or if your portfolio is heavily concentrated in the US, another common approach is to add a separate international allocation. Unfortunately, there is no single Ireland domicile ETF that perfectly mirrors VXUS, which excludes the US while covering both developed and emerging markets in one fund. So what some investors did was to combine 70% EXUS ETF with a 30% EIMI, which together replicate the structure of a broad international index that excludes the US. This method is very flexible, but is also quite mafan because you will need to periodically go in and rebalance the two funds to maintain your target allocation. As such, for myself, I just went with FWRA and call it a day. So, should you invest in international stocks? For most investors, the answer is yes. Not because international markets will always outperform the US, but because history shows us that no single country can lead forever. Even a modest international allocation can lower risk, smooth returns, and protect you from long periods of underperformance in any one market. And over the long run, that matters far more than trying to guess which country will win next. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.